financial services space and to a big development coming in from the central bank on that. In fact, stocks like REC, PFC and IRDA are under pressure as RBI proposes tighter guidelines on provisions for infrastructure project financing. In fact, our colleague Ritu Singh gets us all the details. Tell us, Ritu.
Well, first, to be clear, this is a draft circular on project financing where comments have been invited by mid-June, after which the final rules are going to be framed. Broadly, it sets the floor for minimum exposure that lenders may take for infra projects. It restricts the moratorium to no longer than 6 months if moratorium on repayments beyond the date of commencement is granted in the first place for project finance. But what seems to have really spooked the industry is the provision on a higher provisioning requirement which is proposed in these rules. Now, the draft rules say that there is a classification of projects depending on their phase from construction to being operational and so on, and they propose a higher provision of 5% starting from the construction phase of the project versus the current rules which said that banks had to provide 0.4% and NBFCs 0.25% for the DCCO, which is the date of commencement of a project extension of up to 2 years. Beyond that, the 5% provisioning was already applicable. Now, this 5% provisioning, according to the new circular, can be reduced if certain conditions are met. But for infrastructure projects, the draft note says that if the extension is for more than 2 years, lenders will not only have to keep this 5%, but a specific provision of 2.5% over and above that as well, bringing the total provision to 7.5%. But the good news is it can be reversed on commencement of the commercial operation. Remember, this provision for 5% will not be done immediately. It's going to be done in phases from FY25 to FY27, but importantly, these rules are retrospective in nature, so they will apply to projects that have already been financed, and for large public sector banks specifically, there will be some sort of an impact, as well as for NBFCs in this space. Now, IIFL Securities says that it estimates the additional provisional requirement will be anywhere between 0.5 to 3% of the bank's net worth, and that it can hurt CET1 ratio for banks by anywhere between 7 to 30 basis points. For NBFCs like REC and PFC, there could be a higher impact of 200 to 300 basis points on the tier 1 ratio, while some, there are divided views, however, on when this 5% provisioning will kick in. Some like ICRA this morning told us on the channel that they're of the view that the higher provision is only for deferred projects, while others think otherwise. So some clarity is still awaited from RBI on the exact nature of this 5% provision.
Okay, Ritu, stay on. You're also tracking the latest on